Okay guys, so right now we know that each option contract includes four main parameters, which are the option type, and it can be a call or a put option. The second one is the underlying security, which can be stock market shares or futures or something like that. The third one is the expiration date, and the last one is the strike price. In the previous episode, we also talked about the moneyness of the option. And before going deeper into the option pricing, we will need to learn a little bit more about the important differences between in the money and out of the money options. And first, let's make a kind of oversimplified example of the option contract. Imagine that you have a friend and you want to make a little bet on a Tesla. You think that it will be higher than 1,000 in a year, but your friend doesn't agree with you. So you decide to make a bet. If the Tesla will be higher than 1,000 in 12 months, then your friend will just pay you the difference. So for example, if it will be $1,100, he will pay you this $100 back. Now imagine that 2 months have passed and the Tesla is now trading about $1,200. Your friend did not expect it to go that high and that fast, and he wants to take this agreement back because he now thinks that it actually might go to $2,000. So he doesn't want to lose the 1,000, which will be on top of this strike price. And he is happy to pay you those $200 because it will be a relatively small loss compared to the 2,000 that he expects now. And how he can actually take it back? How can he buy this contract back from you? Well, there will be two things that you need to consider. The first one is the actual money that the person owes to you. In this case, when the price of Tesla is at 1,200 and your strike price is 1,000, the money owed is $200 per share. So in this case, your contract will cost at least $200. And the second one is time to expiration. You agreed with your friend that this contract will be in power for a year. And as you remember, just 2 months has passed, so there are still 10 months. And during that time, Tesla can go even higher than those $1,200. Or on the other hand, it can actually go lower to 800, for example. You do not know it. So those two things are actually what is going to make the price of the agreement. How much they owe you already, and how much time is still left in the contract. I will try to oversimplify it in the beginning. The option price consists of two main things. The first one is the time value and the amount that option dealer will owe you after the expiration, which is called intrinsic value. It is not correct, but it will help you to understand. Intrinsic value is the difference between the strike price and the actual stock price. And the extrinsic value is the actual time to expiration and the stock volatility. For the sake of simplicity, let's focus on the calls for now. Puts have absolutely the same ideas, they're just inverted. So if you listen carefully, you know that options will expire worthless if they are out of the money. If you had a call option on Tesla, for example, with a 500 strike price, and on the day of expiration the Tesla stock price is 490, you will lose all the money that you paid for the option. In this case, traders usually say that the option will expire worthless. But if you still have 1 month left until your expiration, your options will still have some value. Even if the option is out of the money, meaning that the stock price is lower than the option strike price, the option will still have some value. So why is it? Well, think of an insurance again. If you want to buy insurance for 1 week, it will be rather cheap because the probability of something bad happening during that 1 week is pretty low. But if you want to buy insurance for a year, for example, the prices will be way higher. There are way more things that could go wrong over that year comparing to the 1 week. Same thing with options. Even if the option is out of the money, it will still have some value. The more time we have until the expiration, the more chances that the stock will rise and the option will end up in the money. And more chances mean the higher price for the lottery ticket. The more volatile the market means that we have higher probabilities to end up in the money. The price goes up and down every day, so the chances are not zero. And if the stock price is already close to be in the money, the more chance we have. And here we can divide the option into two very different parts. The first one is extrinsic value, which represents the time until the expiration date and the volatility of the underlying security. So if the option is out of the money, the intrinsic value is 0. But if the option is in the money, the value would be the difference between the stock price and the strike price. Again, the out of the money options will only have extrinsic value, because if they will expire right now, they will expire worthless. So the price of the out of the money option is only affected by the time to expiration and volatility. You and your option dealer agreed that he will pay you only if the price is higher than, let's say, 500. If it is lower, he will not owe you anything. But if the agreement still has some time in it, you still have some chances that the price will rise. So the agreement will still have some value. In the money options also have the time and volatility value in this, but they also have intrinsic value, which represents the core of the option price. Let's have a small example. Imagine a call option with a 100 strike price, and its underlying security is currently at 110. The actual option costs 11.50 right now. As I mentioned earlier, the in-the-money options have both extrinsic and intrinsic value. Since we are talking about the in-the-money call option, we can calculate intrinsic value by subtracting the strike price from the stock price. So 110 minus 100 equals 10. So intrinsic value of 11.50 option is just 10. And the extrinsic value is easy to calculate here because it is the rest of the price. 11.50 minus intrinsic value will be extrinsic. 11.50 minus 10 is 150. Calculating extrinsic and intrinsic value for out of the money option is way simpler. Because intrinsic value is always 0 here, all the price of the option is represented by the extrinsic value, or by its time and volatility value, whatever you prefer. So how can you actually use this knowledge, and is it actually helpful and used by real traders? Depending on which side you are on, whether you are selling options or buying options, you will be often interested in the extrinsic value. If you are selling options short, you want the biggest extrinsic value possible because it will earn you more money. Of course, these ideas are not really clear at this moment, and we'll talk about them later. But for now, just make sure that you understand what is extrinsic and intrinsic value, how to calculate them, and if you have some questions, just leave them in comments and we'll try to figure them out. As always, I will really appreciate you subscribing to the channel and liking the video. The more people are watching the videos, the more motivated I am to release new ones. So thank you for watching, and I will see you in the next episode.